welcome. You're watching the Global Reset on CNBC-TV18 Prime with me, Surabhi Upadhyay. This is a show where we merge the lines between geopolitics, markets, and global economics. Today's discussion, of course, has to center around tariffs and what's happening with the US's trading deals with several of its trading partners. We will be in conversation with National Australia Bank's Ray Attrill, who is the head of FX strategy, markets, and Tapas Strickland, the head of market economics. But before we get to the two gentlemen, let's quickly bring our viewers up to speed with everything that's happened in the last 24 hours. Well, the United States has struck a trade deal with Vietnam, placing a 20% tariff on Vietnamese exports. This cools tensions to some extent, or to a great extent perhaps, with the US's 10th largest trading partner, just days before the US president could raise levies on most imports coming into the US as the July 9 deadline approaches. While Vietnamese goods would face a 20% tariff, transshipments from third countries or other countries through Vietnam will face a 40% punitive levy as well. Trump has also said that US can now export its goods into Vietnam at 0% tariff. So what does all of this mean for trade talks with other countries? What does it imply for the nature of these trade negotiations that are going on? And then what's the broader outlook on large economies like the US and, of course, China? Well, to discuss all of this, let's go back to our experts. Like I said, we have Ray Attrill and we also have Tapas Strickland with us. Gentlemen, great to have you on the show. Thank you so much for joining in. Tapas, let me open the floor with you. This was the big overnight headline coming through, and from declaring a 90% tariff, then talking somewhere in the 40s, finally the tariff with Vietnam has settled at 20%. Markets have been rejoicing largely because at least the uncertainty seems to be getting over one by one. What would your thoughts be?
Pleasure to be here. And I think that's the key aspect of what has gone on over the past days is starting to get a little bit less uncertainty creeping through, a little bit more certainty. And that July 9 deadline, if an agreement hadn't been reached with Vietnam, their tariff rate was going to be 46%. So it looks like they've come to an agreement of a 20% tariff rate. That seems to be broadly acceptable to the Vietnamese financial markets. If you look at the main stock index in Vietnam, that's up 0.5% today. You look at the listed manufacturers or who contract manufacturing to Vietnamese firms such as say Nike or Under Armour, their share prices are up about 4% in the US session overnight. So I think financial markets are starting to creep in with a little bit more certainty here. And importantly for Vietnam, although a headline tariff of 20% in itself would be seen as not positive for the outlook, when you think that the US is actually going to be applying a global tariff of about 10 to 20% across most countries, it doesn't really disadvantage Vietnam in regards to their relationship with the US. And I think that's the key thing to drive home here. The Vietnamese economy, and indeed each individual country around the world, is not individually being picked on by the US. The US has said they want to change the nature of their trading relationship with the rest of the world. And Trump clearly campaigned on a 10 to 20% across the board tariff.
All right. So 20% is what's now been set. And in addition, there is a 40% punitive tariff as well for any transshipments, goods that would be simply transiting perhaps through Vietnam, but originating from other Asian countries. So Tapas, what would this mean for a large exporting economy like Vietnam?
Well, I think that's the key thing is the transshipment rate is about 40%. So that has some implications for India. Obviously, India at the moment is undertaking their own negotiations with the US administration. And one sticking point really is when does a product become majority manufactured in India, or when can it be certified as being made in India? And Indian authorities are trying to get a 30% local content rule, and then that being classed as being Indian production. Whereas the US seems to be wanting a 60% domestic Indian content production. So I think that what is going to be happening with the transshipment in Vietnam, as those details emerge, exactly how much does domestic Vietnamese production need to be in the end product to be considered a Vietnamese good, I think will have pretty big implications in terms of how the US administration is trying to tackle this issue with a number of different other countries as well.
Yeah, that's a great point you raised, because we were speaking to an Indian trade expert who said exactly that we need to see if, say, sourcing components from China, electronic components, or even if it's for pharmaceutical companies, I mean, your intermediaries, APIs as they're called, if products or components sourced from a different country and then assembled in India, whether that would still qualify as a true Indian export. So we need to see how this plays out. Let me bring in Ray into the conversation as well. Ray, I mean, markets, at least on the equity side, have just been going higher and higher, even before these trade deals can become a finality. But on the FX side, I mean, it's been a little all over the place. Let's get your opening views in terms of what's transpired on over the last 2 odd months, and how much of a part has the trade uncertainty played in these currency moves?
Well, I think it's played a big part, and I think if we wind back a little bit, think about where we were when Trump was re-elected, and markets were faced with the near certainty of tariffs. The prevailing view at that time, and consistent with economic theory and the past observations of trade tariffs, particularly during the Trump 1.0 era, was that tariffs were going to result in a stronger dollar. So I think the real curio, if you like, in the last couple of months have been that, the threat of tariffs has effectively turned into reality, albeit we still don't have certainty as to actually how that will play out across different countries. And yet we've got a materially weaker dollar. So in a sense, sort of theory and practice is being turned on its head. But what I would say is that, the view that we certainly share is that the impact of tariffs as far as individual economies is concerned, very much the case that the US is going to be, at least in the short term, suffering more economic hardship, if you like, or more of an economic hit than many of the countries that the tariffs are directed at. And I think the overall weakness that we see in the dollar, we can talk about whether we're really seeing a sort of fundamental questioning of the dollar, of dollar dominance and the dollar's reserve currency status. But at a very simple level, we talk about relative economic performance as being important for currencies. And as things stand, it's pretty clear that as far as the first half of this year is concerned, the US has lost its sort of economic exceptionalism. And historically, when the US economy is not clearly outperforming relative to most of the rest of the world, it's been associated with US dollar weakness. And I think in a simple terms, that's pretty much what's been playing out. And as we get the sort of certainty of tariffs coming through, and to the extent that I think the inflation impact on the US is yet to be felt, we will see more sort of economic pain, if you like, probably showing up in the labour market. And we think that's probably consistent with a continuation of the weaker US dollar trend that has been in place since the middle of April.
Oh, yes, absolutely. I mean, things have totally turned on their head, haven't they? Because you have the dollar weakening. I think the dollar index is down 10 to 11%, 12% so far this year, at a time when US equity markets are still resilient. And then the bond market has been somewhere in the middle. I mean, swinging between 4.2 going all the way, close to 5. So it's really been all over the place. And I'll talk more about where we are with respect to the US and what that means for markets over there in just a bit, because there's so much going on. There's also this, big tax bill that we have to discuss and its implications in markets. But Tapas, just to come back to Asian economies and whether the market impact is one part of it, and then there's the economic impact, right? And we need to understand how much of each is played and is yet to play. Markets typically discount the future. So what would you say from a tariff standpoint? Say now that we have the final number on Vietnam, we have a fairly clear handle in terms of China as well. Has the market impact entirely played out, or would you expect more volatility as the tariffs get real and it starts percolating down to the real economy?
That's a really good question. And I think it really depends in which economy that you're in. And I think to some extent, the US still has a little bit more percolation to occur, if you want to use that term, most because we haven't really seen too much of an impact from the tariffs in the actual macroeconomic data of the US. So inflation hasn't really shown too much of a tariff increase. And we'll be looking at the inflation reports over the next couple of months to see if that actually starts to flow through to the US economy. If it's not showing through in the US economy, then it's either being absorbed by firms in the US, so in which case margins should be a little bit more under pressure, so that may present a headwind to the equity market, or the countries that are bearing, the countries that have these tariffs imposed on are absorbing some of the cost, or in Trump's
no, but
terms,
Tapas, so actually this question was more for some of the Asian countries and the Asian economies. And we'll come to the US in just a bit. In US, maybe it's not showing up because the tariff numbers are not yet real. Now they are. I mean, finally, we know that it's going to be that much more expensive to, say, import from Vietnam. But on Asian economies, what are you penciling in for the second half for major Asian markets and economies, whether it's China, whether it's Vietnam, maybe South Korea, any of the key markets that you track around the region?
Yeah, so we're not really expecting too much of a change in terms of economic momentum from these tariffs. And as I was saying before, the key thing is no single country is being singled out alone in terms of tariffs. If they were, then yes, there would be definitely an economic impact as economic activity migrates to other countries that have less tariffs on them. But the key thing to note is the US is applying a broad-based 10 to 20% tariff across most countries, and it seems like that seems to be the negotiating point there. A larger tariff, of course, is being placed on the Chinese economy or Chinese-produced goods, and for any transshipment that is going to go through some of those other countries. So in terms of the tariff impact, from an economic point of view, the biggest impact is going to be on China. And then the real question is, well, do the Chinese authorities start to stimulate their economy as some kind of offset towards that? And we haven't seen too much in the way of that. And we do know we've had some fairly soft Chinese numbers most recently. The other aspect to note, though, is there's a big defense component here. And a lot of countries in Asia have a relatively low defense budget as a share of GDP. And for those people who are more aligned with the US, and so I'm going to class India in this basket as being part of the Quad with Japan and Australia and the US. The US administration is very clear that it wants its allies in Asia to lift up defense spending. And in Australia, we're spending about 2% of GDP on defense. In Japan, for example, they're spending about 1.5% of GDP on defense. They want that lifted up to 3.5% of GDP. So that may provide actually some form of stimulatory policy on the defense side that may offset if there are any trade headwinds out there.
Okay. A lot of the major exporting economies of Asia, I wonder how they'll be managing their own budgets and increasing the spends on defense when they're going to be maybe earning a little lesser from exports and from trade. But that's an ongoing question. Ray, before we take a break and talk about the US, just give us the standpoint on Asia FX. What can you gauge ahead as a lot of these trade agreements get finalized? What's your view on, say, on the yuan, on the yen? What do you see ahead next couple of months?
Well, the Japanese yen is interesting. So going back to that discussion, one of the big uncertainties is where we land as far as Japan is concerned. And obviously the signals coming from President Trump are pretty ominous there in terms
30% he's saying, right? Threatening 30 to 35%.
Autos and rice, so that seem to be points on which there is a real impasse effectively there. So Japan being the second largest economy in the region, how that plays out is important. But clearly the Bank of Japan is going to be sitting on its hands, whereas otherwise might be tightening policy. Our general view is that in the context of a weaker dollar, despite the fact that China will be suffering one of the biggest imposts as far as tariffs are concerned, in the context of a weaker dollar, we still think for choice that the Chinese yuan will be allowed to strengthen. And that's going to be really important because at the moment we're seeing as other currencies are strengthening in the context of a weakening dollar, if China really holds the line as far as the dollar against the renminbi is concerned, it means that the yuan is effectively weakening against other Asian countries, whether it's North Asia or ASEAN, and that's a problem for those countries. So to Tapas's point about, on a relative basis, no one is really being hurt, but from a currency and export competitiveness in that regard, if China doesn't allow a weaker dollar to be reflected in a stronger yuan, it means that the Chinese yuan will be weakening on a basket basis and against those currencies. And I think politically, that's going to be an issue for those countries. But our core view is that we will see sort of broad-based Asian currency strength, including the Chinese renminbi, assuming, as we do, that the US dollar will continue to weaken. And in the short term, perhaps one exception could be the yen, if it is the case that the Bank of Japan is going to be sitting on its hands for longer, rather than allowing that policy of policy normalization to play out.
So if I were to ask you in terms of further currency appreciation in Asia, ASEAN Asia, for the rest of this year, which markets and which currencies would you track most closely? The yuan you mentioned for obvious reasons. Which are the other ones to look at?
Well, we're not EM currency specialists. We look at China, particularly because of its feedback here to Australia. So, at this stage, I wouldn't be differentiating between them, but I think that, it's really going to be led by the yuan. But, good reasons to think that, most of the other currencies, in the region that don't have sort of idiosyncratic sort of political issues, for example, will probably, strengthen broadly in line with the performance of, say, the DXY US dollar index against major currencies.
Okay, so more currency appreciation expected across China and, of course, maybe other Asian countries as well. Got that. So that's good clarity. We need to take a very quick break, and then we come back and focus on the U.S., the economy, which so far has been resilient, markets, which so far has been resilient. What lies ahead for investors? We'll discuss this after the break. Welcome back. You're with us on the Global Reset, and this is CNBC TV18 Prime. Now, the US dollar has been on a downward slope despite the support of geopolitical risks over the last couple of weeks and, of course, the short-lived spike that we saw in oil prices. In fact, the shifting global landscape has prompted central banks to perhaps reconsider reserve currencies. Before we get back to our conversation with the guests, let's quickly take a look at the report that was filed last week on this very same issue.
The custodians of trillions of dollars of global central bank reserves are eyeing a move away from the greenback, with gold, the euro and China's yuan all in favour. It comes as the splintering of world trade and geopolitical upheaval has sparked a rethink of financial flows. A report by the official Monetary and Financial Institutions Forum is due to be published later on Tuesday. It says 1 in 3 central banks managing a combined $5 trillion plan to increase exposure to gold over the next 2 years. The survey of 75 central banks was carried out between March and May and gives a first snapshot of the repercussions of Donald Trump's tariffs. Gold, which central banks have already been adding at a record pace, is expected to benefit further, with around 40% of central banks planning to increase gold holdings over the next decade. The US dollar, the most popular currency in last year's survey, fell to 7th place this year. 70% of those surveyed said the US political environment was discouraging them. In currencies, the euro and yuan stand to benefit the most from the diversification. Around 16% of central banks surveyed by OMFIF said they plan to increase euro holdings over the next 2 years. That makes it the most in-demand currency, up from 7% a year ago, followed by the yuan. The survey respondents expected the euro to reach about a 22% share of global reserves in 10 years' time, but Europe could attract a higher share of reserves sooner. Sources speaking to reserve managers say that's if the bloc is able to boost its pile of bonds that are currently dwarfed by the $29 trillion US Treasury market.
Okay, well, is the reserve status, the dominance of the US dollar, is it really getting challenged? Let's go back to our experts, and this is exactly the point that Ray was making a while back, while telling us that the broad outlook that the bank has is that there will be more dollar weakness perhaps in the weeks and the months ahead. Ray, expand on that point. I mean, till now, at least, most US economic indicators have held up. Now, we'll see what the jobs report for June tells us later this evening. But markets otherwise on the equity front have also been resilient. So, what is behind this dramatic 10, 11% drop in the dollar? And why is it that you're expecting more weakness?
Well, going back to what I was saying, it really is at the moment, I'd say, a loss of US economic exceptionalism, is a key sort of cyclical driver of the weakness that we've had. But I step back under the hood. I think there are some currents, and I think that OMFIF survey that you cite, obviously touches on some of those. Although I would say that the general theme of that report was effectively diversification, not a loss of dollar dominance. And you think about those numbers in terms of the euro, for example. The euro currently takes a 20% share, and they're talking about it going for 22%. I'd remind you that before the the Greek Eurozone crisis back in 2011, the euro share was 28%. So it's a real crawl back. And, we can talk all we like about the loss of the US dollar's reserve currency status, but it is, and as you alluded to, or the report alludes to, it's the lack of alternatives in terms terms of the sheer size of the European capital market and the lack of an integrated capital market. And in the case of China, the fact that they don't have, there are still capital controls, basically, so you don't have full capital account convertibility. And they're both major constraints on the speed with which reserve managers in particular can diversify out of the US dollar into other currencies. But at the same time, I think one of the big thematics that is going to keep the US dollar pressured is that there's something like $2 trillion US dollars worth of foreign ownership of the US equity market that's been accumulated, particularly since the GFC. And a lot of those securities holdings are unhedged, or there's only very light hedges being applied to those back into local currencies. Here in Australia, for example, asset managers or the superannuation or pension funds only hedge about 30% of their exposure back. Now, if, as we expect in the context of a weakening dollar, asset managers decide that they want to hedge more of that exposure, that will create the flows that I think will continue to drive the US dollar weaker over time.
That's a very interesting input to keep in mind, that a lot of this US exposure has been largely unhedged, and maybe we start seeing some of that change. Tapas, comment on this, the shift in flows. I mean, it's only a trickle considering, the concentration that investors have had with respect to US assets, whether it's bonds or whether it's equities. But what do you pick up? Do you expect it to accelerate? Is it just a passing phase and the market will go back to US superiority once they realize that tariffs are done and dusted? Because what started as a bit of a panic in early April kind of settled soon enough.
I don't think we'll go back to where we were before. And on top of the themes that Ray talked about, I think the two other things was the big thing that happened that drove at least initial diversification from the US dollar towards gold was the confiscation of Russia's FX reserves by the G7 and Australia when they invaded Ukraine. And for many emerging markets who may not be fully aligned with the US administration or a potential US administration, that really got people thinking about the need for diversification of their foreign exchange reserves and external reserves in general. And there was a recent World Gold Survey report out, and it noted that where central banks were pivoting towards diversification towards gold, it was predominantly from the emerging market central banks, while developed market central banks weren't pivoting that greatly towards gold as an asset class to underpin their foreign exchange reserves. So I think that's one particular aspect. And the second particular aspect really has to occur in terms of the US as an investment destination. And there, two sub-themes have emerged. So one, it was once thought that US was dominating in terms of AI, and the US was the only place where you could get exposure towards AI. And the revolution of DeepSeek from China really cast a wider net in terms of other countries developing their different AI industries. So no longer do you have to be in the US to get that AI exposure. So I think that's a pretty key theme.
Yeah.
And then the other subset towards that bit of it as well is sovereign data capability. There are a lot of cyber attacks going on right around the world. Authorities in many different countries really want people to have data sovereignty. How's that data, if it is in a cloud, have that cloud, the underlying data actually based in their own country. So I think that's starting to change some of the undercurrents in terms of the US exceptionalism, particularly in regards to US tech investment.
No, absolutely. I mean, both of your points are very well taken. Diversification is one of the major reasons why we've seen this dramatic move in the US currency. But as we wind down the conversation, let's come back to brass tacks as well. And that's the strength or the resilience in the economy itself, whether it will last or not. And what's your sense, Tapas? We spoke about inflation, right? The inflation number, some estimates say could well be over 3% by the time the full impact of the tariffs flows through. There are other commentators that I've heard from who say that it won't be that bad because firms will have to, digest some of it. So what's your sense? And so far, the labor market's held up. The Fed hasn't moved for these very same reasons. But what do you expect for the US economy as we get into the second half?
But we're expecting a broad slowing in the US economy, but we're not expecting a recession in no way. We're expecting the unemployment rate to gradually creep up, but that rise to be really counteracted by expected Fed rate cuts here. And I think from a more generic economic viewpoint, I think we should be thinking almost that these tariffs that the US is placing on the rest of the world could be seen effectively as a domestic tax increase in the US. And then the real question is, what does the US government actually do with that revenue? And we do know from the budget bills that are being discussed in the US at the moment, looks like it's going to get passed, that money is actually being redirected throughout the US economy. So it's not the fact that you're taking this money out of the US economy via tariffs and you're using it to reduce your budget deficit. You're actually using this money to redirect throughout your economy. So in that sense, the economic impact may not be as large as what some people are thinking out there.
So Ray, final word then, and any estimates on how much more dollar weakness, say, over the next 6 to 12 months?
Well, in our forecast, we're pretty much saying same again. And I think probably important to bear in mind that on any sort of fundamental valuation metric, the US dollar remains significantly overvalued. So it's built up a huge sort of overvaluation over the last, particularly since the global financial crisis. So we would still put the US dollar at 10 to 15% overvalued here. And I think what we're seeing, we can just see it as a, as a long-term sort of cyclical downturn in the US dollar, although I do think there are some structural or secular forces at play here. So in our forecast, we've had that DXY dollar index going from, above 100 down to the 90 area, and we've got it down, 110 to the high 90s. We've got it down another 10% or so over the course of the next 12 months. At this stage, difficult to know whether, we should extend the falls to there. I think there are still lots of question marks. If markets really start to question, for example, the independence of the Fed, as and when we learn who is going to replace Jay Powell as chair, if there's a genuine fear amongst markets of a loss of monetary independence, I think that is a recipe for a much deeper US dollar correction than the one we currently have in our forecasts.
Oof, that would mean many more sleepless nights for market participants and financial market commentators like us here in Asia. So let's see, pretty dramatic headlines out of the US in the last couple of weeks. Thank you both very much for joining in. A very, very insightful discussion. Thanks for being with us on the Global Reset.